Good morning. This is Japanese Economic Review Channel. Welcome to the April 13 to 17 market briefing. This week's theme is the divergence play. We are seeing a historic decoupling. Despite lingering Middle East tensions, such as the Israel-Lebanon flashpoint, Japanese equities are breaking free from macro fears. We will explore how capital is repositioning for an AI-driven boom while navigating the highly volatile USD-JPY dynamics. The market is at a critical inflection point. The old correlation of high oil causing stock sell-offs has broken. While overhangs remain, specifically the U.S. Iran peace talks, U.S. CPI, and BOJ intervention risks around 160.46, the growth engine is roaring. The Nikkei decisively broke its 54,000 yen consolidation, targeting up to 58,900, fueled by anticipation of global semiconductor earnings. Looking at the threat matrix, the landscape remains fragile. Initial U.S. Iran peace talks in Islamabad provide hope. However, this is offset by Israel's recent airstrikes in Lebanon and Iran's threats to close the Strait of Hormuz. Despite these severe risks, Iran's currently restrained responses are preventing full market panic, allowing investors to look beyond immediate geopolitical noise. We face two scenarios. Scenario A: de-escalation via successful Islamabad talks would stabilize oil, ease inflation fears, and trigger a massive relief rally in AI tech. Conversely, Scenario B: a breakdown in talks would spike oil, reignite inflation, and surge safe haven USD demand. However, note that AI structural strength may selectively resist even a broader market sell-off. Why does this crisis drive the dollar? It starts with geopolitical triggers, like President Trump's stark warnings. This sparks a commodity shock with surging oil prices, leading to renewed U.S. inflation fears. Consequently, early rate cut expectations evaporate. Ultimately, this combined safe haven demand and structural yield advantage sends the USD-JPY skyrocketing. Trading around 159.12, the USD-JPY faces intense push and pull. The BOJ intervention danger zone looms above the March 30th high of 160.46, capping upward momentum. Conversely, our technical floor sits at 156.78, backed by the 100-day moving average. Our expected range is 156.50 to 161.00, highly dependent on the U.S. Iran ceasefire protocols and incoming U.S. CPI data. This chart visualizes the great decoupling. Despite elevated geopolitical risk indices and threats like the U.S. private credit overhang, equity market sensitivity is drastically dropping. Institutional capital is essentially ignoring the macro noise. The Nikkei's breakout proves that structural sector strength in AI is now overriding traditional macroeconomic gravity. The locus of market momentum has shifted to the semiconductor earnings supercycle. Two key catalysts define this week: ASML earnings on April 15th and TSMC on April 16th. These specific nodes provide structural tailwinds, supporting the Nikkei's aggressive upward momentum. Supply and demand dynamics currently heavily favor this AI supply chain expansion. Synthesizing these forces, we are transitioning to an earnings-driven market. While geopolitical premiums exist, they are capped. U.S. CPI and the IMF outlook serve as final macro hurdles. Tech fundamentals are successfully absorbing macro shocks. The bottom line: smart money is viewing volatility strictly through the lens of earnings strength, rather than macro fear. Finally, our tactical roadmap. Keep a close watch on Tuesday's IMF outlook and US PPI, followed by pivotal ASML earnings on Wednesday and TSMC on Thursday. Also, pay attention to any unscheduled remarks from BOJ Governor Ueda regarding exchange rate dynamics. Navigating these catalysts correctly will be crucial for positioning in this newly decoupled market. Thank you for watching the Japanese Economic Review. We look forward to having you with us again.